Welcome to today's Explainer, where we're going to completely unpack the mechanics and the hard financials behind the highly anticipated 2026 Shiprocket IPO. Now, if you've been keeping tabs on the Indian startup ecosystem or the logistics sector, you already know Shiprocket has literally been the name on everyone's lips lately. But you know how it goes with these massive public offerings, right? It is so incredibly easy to just get swept up in the market frenzy and completely lose sight of the actual ground-level data. So today, we're skipping the noise. We're going to look straight at the fundamentals and see what's really going on under the hood.
All right, let's just address the elephant in the room right off the bat, 26.80%. That massive number is the expected gray market listing gain, and it's the exact figure that is generating some serious buzz among retail investors right now. When you see a potential pop like that before a company even hits the public exchanges, yeah, it naturally commands attention. But we have to ask ourselves, what is actually driving that nearly 27% expectation? Is it purely just speculative momentum, or is there a rock-solid business model justifying that hefty premium? Well, let's find out.
To figure that out, we'll quickly run through these 6 areas today. First, the Shiprocket IPO buzz. Second, key IPO mechanics and timelines. Third, following the fresh issue funds. Fourth, the revenue versus profitability paradox. Fifth, the short-term listing outlook. And finally, long-term growth and risks.
Okay, kicking things off with Section 1, the Shiprocket IPO buzz.
So the key informal indicator everyone is watching right now is the gray market premium. We're seeing a premium of 26 rupees, which basically pushes the estimated listing price to 123 rupees. That is well above the 97 rupee upper price band set by the company. As of early August 2026, the gray market is signaling just immense retail and institutional appetite. Investors are essentially saying, hey, we're willing to pay a massive premium over your highest asking price just to get a piece of the action. It's a fantastic gauge of short-term sentiment for sure, but man, it also sets an incredibly high bar for the company to actually perform on listing day.
Let's move into Section 2, key IPO mechanics and timelines.
Timing is absolutely everything here. The IPO opens on August 12th and snaps shut just 2 days later on August 14th. Literally, if you blink, you're going to miss it. Then the tentative listing date on the BSE and NSE is right around the corner on August 19th. This super compressed, strict window shows the rapid pace of the offering. It means you absolutely need to have your capital ready and your strategy locked in before the window even opens.
And looking at the sheer scale of this thing, it's a 1,617.5 crore total issue. Now, this is split into 2 very distinct buckets, an offer for sale from existing shareholders and fresh capital for the company. It's really important to understand this distinction. The offer for sale, or OFS, of 732 crore, that's essentially the early investors and promoters taking some chips off the table. But the slightly larger chunk, the 885.5 crore fresh issue, that is the lifeblood for Shiprocket's future. That is entirely new money flowing directly into the company's treasury to fuel their next phase.
So how much does it take to play? Based on the 154 share lot size at the 97 rupee cap price, the barrier to entry starts at an incredibly accessible 14,938 rupees for retail investors. From there, it scales all the way up to over 1 million rupees for big high net worth individuals who have to bid for a minimum of 67 lots. By setting that retail minimum just a hair under the standard 15,000 rupee threshold, the lead managers are doing something very smart. They're guaranteeing maximum participation from everyday retail investors. And honestly, that accessibility is a huge factor driving up that initial hype we talked about earlier.
All right, on to Section 3, following the fresh issue funds.
So we know they're bringing in a ton of fresh capital, but where exactly is it going? Well, this breaks down the first 3 of the 5 core strategies driving their overall growth. Strategy 1, 365.6 crore is aggressively earmarked for platform growth and expansion. Strategy 2, 205.8 crore is dedicated purely to marketing and acquisition to capture new users. And Strategy 3, 159.8 crore goes directly into building robust tech infrastructure. You see what they're doing here? This is a classic growth at all costs capital allocation playbook. They are spending heavily to acquire market share and simultaneously building out the tech backbone to handle that scale. The remaining balance just goes towards some debt repayment and general corporate housekeeping.
Which brings us to Section 4, and frankly, the most fascinating part of this whole explainer, the revenue versus profitability paradox.
The top-line numbers here are just phenomenal. Shiprocket is experiencing explosive multi-year revenue growth. They're projecting a massive 2,024 crore in revenue by FY26, starting from 1,316 crore in FY24, stepping up to 1,632 crore in FY25, and then smashing past the 2,000 crore mark. That represents a stellar 24% year-over-year revenue growth trajectory. The logistics market is obviously expanding, and Shiprocket's direct-to-consumer ecosystem is capturing a gigantic slice of that pie. Honestly, if you only looked at this one chart, you'd probably think this IPO was a guaranteed slam dunk.
But actually, hold that thought, because here is the crucial catch. Despite this booming 24% revenue growth, and despite narrowing their operational EBITDA loss to negative 3.31%, they still haven't achieved bottom-line profitability. Their profit after tax, or PAT, is projected to sit at a negative 79.25 crore for FY26. And this is the paradox, right? They are scaling their revenue brilliantly, and their operational margins are definitely moving in the right direction, but at the end of the day, a loss is still a loss. For anyone looking at the fundamentals, the ultimate question is simply, how long are you willing to wait for the company to turn definitively, reliably profitable?
Let's pivot to Section 5, the short-term listing outlook.
So what's going to happen on listing day? Well, that strong demand and those narrowing losses are exactly what's driving that 26% expected gray market gain we saw at the start. The short-term sentiment is undeniably positive. They are the leading D2C platform with killer revenue metrics. However, it's absolutely vital to remember that the gray market is entirely unregulated. It is completely subject to actual subscription volume. If the official subscription numbers between August 12th and 14th don't quite match the intense hype, that gray market premium can evaporate literally overnight. Your real listing gain is going to depend entirely on how many times the issue gets oversubscribed by the institutions and retail bidders.
Finally, Section 6, Long-Term Growth and Risks.
Looking past the chaos of listing day, we have to look at the last two of their 5 key growth strategies. Strategy 4 is leveraging their massive, booming ecosystem that reaches over 24,000 PIN codes. And Strategy 5 is their expansion into high-margin software as a service, or SaaS, delivering specialized tech solutions to their merchants. Now, those are powerful drivers, but we have to weigh all 5 of these growth strategies directly against their major risks, primarily an unproven path to net profitability and a very heavy reliance on third-party delivery partners like Delivery and Blue Dart. Basically, they don't fully control their own supply chain or delivery margins. To sustain long-term investor confidence, they absolutely must cross that threshold into being PAT positive.
So I want to leave you with this final thought to ponder as you review your own data. In this hyper-competitive logistics landscape, will explosive top-line growth, driven by these 5 aggressive strategies, ultimately be enough to satisfy the market if bottom-line profits remain totally elusive? It is a very delicate balancing act between rapid, aggressive expansion and the harsh, cold reality of net losses. Thank you so much for joining me on this explainer today. Dig into the numbers, consider your own risk appetite, and keep learning.